So I'm going to tell you how to improve your chances of getting a mortgage. So you should be checking your credit report with the three main agencies out there. So Experian, Equifax and TransUnion. The reason why I say you need to check with all three agencies is because they can hold different information about your financial arrangements. Now, the information on there needs to be accurate. So when you look at the report with each agency, make sure the information is correct. Now, the problem is it can take a while for any errors to be rectified. So that's why you need to do this way ahead of planning to take out the mortgage or remortgaging. Now, the other thing you want to check is whether there are any financial associations. They will show on your credit report. Now, that is where, for example, you may have had a joint account with an old partner, and that means that your credit reports are linked, and that can adversely impact your ability to get a mortgage if, for example, they have a very bad credit report. Also, do make sure you're registered to vote. The reason you do that is positive for your credit scoring, but it is also used as evidence that you live where you say you do. So make sure that you're on the electoral roll. If you don't know, contact your local council. Make sure you are managing your existing debt correctly. Make sure your debt levels are nowhere near your income levels. Lenders will look at something called a debt to income ratio, and it's an important metric when you do apply for a mortgage. They will calculate that by adding up all of their monthly debt payments, and they divide this by your gross monthly income and multiply it by 100 to give you that percentage. Now, what lenders do is characterize you by the level of that debt to income ratio. So if it's over 50%, then you're considered a high risk borrower, and that will mean you'll probably need to use a specialist mortgage lender. If you're between 30% and 50%, then that's acceptable to a moderate risk, and you'll generally be eligible for most standard mortgages. But if you are less than 30%, then you are deemed a good borrower, and you're likely to be approved for most mortgages out there by most lenders, and you'll probably receive the best rate as well. So you want to maintain a good debt to income ratio. So make sure you calculate what that is, and if you have to, then pay down any debt with savings that you have. Now, that leads on quite nicely to something called credit utilisation. You need to know what your credit utilisation is, and that is the percentage of your potential debt you've got access to that you are using. So if, for example, you have credit cards that give you a total of £10,000 when it comes to available credit, and you've got a balance of £5,000 on those credit cards, then you've got a credit utilisation of 50%. Now, lenders prefer you to have a credit utilisation of less than 50%. So maybe aim for something like 30%. So the message is avoid using all of your available credit if you're looking to get a mortgage in the future.